Yeah, I know. Hey, how's everybody doing out there? Hope you're
Nice, nice.
doing well. Welcome to another episode of Return Us, where capital meets conviction. Once again, I'm Marvin Clement.
William McCoy, and today we are focusing on the investor.
Whoop, whoop, whoop.
So, big story today or a few days ago was NVIDIA is investing $1 billion in an AI startup called Poolside in this partnership. That's the kind of move that doesn't just happen in a vacuum. It signals where the frontier is shifting. So, what do you think about that, Marvin?
Well, a billion's a big number, but and you know, for the investors out there, this isn't just tech news. The way I see it, man, it's kind of a blueprint because anytime one of these mega corporations, anytime a trend industry leader makes a move like this, uh, it's going to help people capitalize on what's to come next. So it's always a good idea to see what the blueprint is and what the big play is, so that you can get oversized returns before everybody else starts to jump in. So I think we're going to see a flashpoint here pretty soon.
And for people who don't know what poolside is, let's just break it down for them. So, poolside, the reason why they are investing in this is that poolside is in the US and Paris, and it has a product that is focused on automating coding, specifically government and defense applications.
Oh yeah.
Its ambition is to create artificial general intelligence. That's something that you guys are going to start hearing more and more of. So for NVIDIA, who has the ability to do these type of things, investing in a company like Poolside, that signals that there is a big strategic value to NVIDIA for investing in this company. For example, they're taking a 2.9% stake in order to be able to do this. This signals big players that are coming in. According to investing.com, Nokia is putting money into it. So this is huge, Marvin.
I mean, it's big indeed, man. It's major moves because when we got to look when a company like Nvidia, a company essentially Nvidia powers the AI boom. Let's just put it out there. I mean,
Yeah.
it's no secret that they are the lead, they're the industry leaders. So everything from the chips, the infrastructures, everything. So when a company like Nvidia makes a move like that, I mean, it's sending a very clear message that the next big wave is not going to just be software. It's going to be infrastructure. It's going to be platforms. It's going to be network. There's an ecosystem that is growing right in front of our eyes, and the stack beneath AI has to be fortified for this ecosystem to grow, and that's kind of where NVIDIA is, and that's where things are going.
So if you are an investor and you're looking to place capital, valuations will climb, competition will increase, but early access is what's going to yield you the great upside. And we talked about this before as to why alternative investments are things that people should be looking at. The market's going to be great, but it goes up and down. But just to give you an example, what if you had invested through a crowdfunding portal in Poolside, and now they're looking at $1 billion investment by NVIDIA? I don't know what your return would have been, but I can say that if you had been on the winning side of this, the early side of Poolside, you would have been looking pretty happy right this minute. So that's what we're going to be talking about. That's what we're going to be breaking down. Marvin, break it down for him.
Let's break it all the way down. Macro tailwinds for AIs and startups. Let's talk about it. All right. So let's break out why the timing is so compelling right now, so compelling in the alpha in this sector. So the first thing we need to talk about, if you're familiar with the term TAM or total addressable market. So obviously AI is no longer a niche. It touches enterprise software. It touches everything: infrastructure, networking. AI is everywhere, even in the shopping market. So you better scan everything on your cart because it's getting better. So the next thing we're talking about is like the infrastructure squeeze. The compute, storage, data flow, demands are exploding. The cost to build is high, but the margin for those who serve it can be large as well. All right, so infrastructure is being infected as well. Early stage inefficiency. So a lot of capital flows to public names, right? So private early stage, especially outside the Bay Area, it all remains underinvested. So remember, anytime something is underinvested, that equals opportunity. And then you have what's called platform multiplier effect. So you got to when infrastructure firms scale. Again, we keep saying this. When anytime something scales it and grows, it creates an ecosystem. So that allows for the production of tools, applications, and different marketplace. And the bottom line is where there's a new infrastructure, where there is new ecosystem, it's going to spawn winners. What you think, Will?
Yeah, absolutely. When the giants invest in infrastructure, the micro winners build apps. This is the time right now that you're going to see a lot of companies coming out with what we talked about when it came to founders in our most previous episode, finding these niche that they can fit into when it comes to these big companies for acquisition. So we talked about founders finding their niche in AI and then partnering with bigger firms. If you as an investor, if you're looking at wins, you should definitely be looking at these niches like Poolside that is targeting AI automation of coding, which is going to be huge for government and defense sectors.
Most definitely. Well, now we're going to come to the segment where we're going to talk about what, because we always want to give you a gem as to practically what you can do about it. All right, all that sounds good, but Will, why are alternative and crowdfunding platform? Why does that matter?
Yeah, I mean, it matters. Again, billions of dollars is going to start going into internal investments according to BlackRock, right? Billions of dollars are already starting to flow in there into those areas. Money is starting to be able to move faster through tokenization. So alternative investments are going to start to matter more and more. So if you're an investor, you're asking yourself why to participate. Well, one, you got the big guys participating. But if that's not enough for you, let's break it down. One path to it is through equity crowdfunding. And that equity
Mm-hmm.
crowdfunding allows you early access to early stage companies. Why is that important? Well, it allows you to invest in companies before they hit it big, like Poolside, right? That's a great example. It allows you to get in
Yeah.
early before they get too big for you to be able to get in. It diversifies your exposure. Always talking about diversification of investments. That's how the winners win. They don't win by putting all their eggs in one basket. They win by diversifying their investments. One is down, the other one may be up, right? So rather than
Mm-hmm.
just picking one mega cap, you can annihilate across 5 to 20 different early startups, spreading your risks and increasing your chances of a winner. Now, there's always going to be risk. We always have to tell you that according to FINRA and SEC, all investment has some risk, but you can mitigate that risk or pull down that risk, buffer that risk by going ahead and diversifying. And then
Yep.
democratization effect, right? More founders globally, more platforms, more access, more deals. That is one of the things that we're going to be tackling with Karuti and our upcoming platform. We want to be able to have you invest in companies not just here in the US, but eventually companies outside of the US, creating that
Right on.
effect, that network effect. There may be a deal in Latin America that you want to invest in. Maybe it's something that's happening in Brazil that you find interesting, that's blowing up. Whether it's in the Amazon, somebody creating an app that can turn, trees into rubber or plastic or whatever it may be, or there may be something happening in Africa where an EV company has figured out a way to create a self-cooling truck or whatever it may be. All these things you'll have access to through our upcoming platform, which then allows you to be able to invest globally. Again, diversifying your exposure. And then potential for outside returns. Think about why the wealthy are investing in startups. It's not just because they love startups. They do love the ideas, but again, the return they end up receiving when they invest early in companies just like the one that we talked about, Poolside. Think about what those guys are looking at right now. That's a unicorn company. It could potentially
Yep.
become what is called a decacorn, which is a $10 billion company. If you had invested in that company early, your multiples would dwarf the public market. I mean, you'd be looking at the public market like, man, I can never get this in that time period. Now, again, typically when these companies do this, it's anywhere from 2 to 10 years that it takes them that time period. But again, during that time period, your portfolio could be looking amazing because you decided to invest in an early startup like this one, and you see the return that ends up happening when you do
Mm,
that.
definitely. So if you look at the landscape and you see what's brewing and what's growing, you can. It gives you some. it gives you some directions on where you can invest early and you can mitigate your risk with crowdfunding. And as Will point out, it's going to help you definitely lower your risk, which is going to help with your returns. And you have to remember, you don't have to be the next NVIDIA. You just have to back the companies that enable somebody else's NVIDIA. I'd rather get 10% of 100 different things than try to hit the lottery. So that's the power of crowdfunding. Right,
Yep.
Will?
Crowdfunding gives you that ticket, right? It about allows you to invest small amounts into different companies and bet on a potential racehorse that may be a winner. So moving on to the next part of what we're talking about, risk and structure. Tell us about risk and structure and how that works, Marvin.
Sure. Well, a lot of people, that's not going to be their favorite word, but every investment comes with some level of risk. We know this. So early stage meaning risks, but we got to understand what the guardrails are so that you can mitigate those risks. So, the first thing you want to take a look at is deal vetting. So, evaluate the thesis. And this is in terms of looking at a potential investment, if I didn't say that. And if you're new to investing, information, research, and knowledge are powerful. So, when you're looking at a deal, evaluate the thesis, look at the team, traction, market size, differentiation, and, feel free to look up anything I just said. Next thing you want to do is you want to check the size and allocation. So, in terms of even crowdfunding, you don't want to overcommit to anything. Maybe your alternative allocations are 10 to 15% of a total portfolio. It gives you a spread and it gives you a margin so that you can mitigate your risk. Then you're going to take a look at the exit path. Understand expected timelines. Very important because that's going to keep you from being disappointed and it's going to free up what you do with your capital. So you need to understand what the timeline for deliveries are. Secondary markets, acquisition potential, those are your verticals. So, you have to understand these, well, you should understand these things when you're making a decision. So you also want to be familiar with follow-on capacity. Winners often require additional funding. That's not a bad thing. So you can ensure you can participate or set expectations accordingly. Sometimes $5 might be seven, but they're still going to win. I always use examples. Sometimes mid NBA season, they're going to spend a little money to get that next piece that gets them over to the championship. Right? They're
Right.
still going to get to the goal, but you might need to get that Kobe needed Gasol or Jordan needed Pippen. You get the idea. So next, you want to talk about alignment and rights. So you want to check your investor rights, dilution protection, governance, and early rounds. So do your homework.
And risk isn't about being early; it's about being early without a framework, right? Um, when you're looking at risks, you want to have this framework in mind when you're looking at things because, again, the risk is going to be there. But if you have some frameworks according to how you are going to go about your investments, it's going to help you in the long run.
Yeah, definitely. So now we're going to talk about an example, and I'm excited about this one. I'm going to let Mr. McCoy tell you about it, though.
Okay, so let's map a scenario. You invested via crowdfunding, um, $1,000 across 10 early stage startups. Suppose two fail, six return your capital, two become major winners, 10, 20x. One of them is acquired and goes on to become a public company in 45 years, which is pretty typical for a 100 million exit. Your weight returns yield four times your portfolio, return over 5 years. That's not typical in the public market returns, right? And that's
Mm-hmm.
why you see so many of family offices and other people who are what we call accredited investors going in on early stage. You can put the money in the S&P and yes, you'll probably do fine, but you just can't find those type of returns in those timelines typically on the S&P, even if you're investing in the FANG companies. And that's
Mm-hmm.
why you have so many wealthy people putting their money into alternative investments because the return is huge. One of the great things about it is that when you combine technology with real estate, which is what we're trying to do, now you add some stability to those returns with a hard asset. Yes, technology is great, but now you have this hard asset that may even produce an actual product in some cases with some of these startups, right? That's something that
Mm-hmm.
you just can't beat.
100% will. Guys, get into things early because time. is one of the greatest contributing factors to success with any investment. Not only the duration, but point of entry. So things like getting into the mega infrastructure for NVIDIA's early can have a huge difference on how you capture a valuation entry point. And there's plenty of other areas, but the most important thing is do your research and take that chance. So what do you do now if you want to learn more? Well, as we always tell you, visit Karuti.com. We're curating the frontier stage equity crowdfunding opportunities that align with macro shifts like AI infrastructure.
And then also be sure to subscribe to ReturnUs at returnus.com. You can catch us on YouTube. We have our shows there, but you can also catch our shows on, if you listen to, on Spotify as well. And we will continue to follow up with you with most if, if up-to-date information when it comes to both founders and investors. We absolutely thank you guys for sharing your time with us. We look forward to seeing you next week.
Invest smart, stay blessed. This has been another episode of Return Us. Peace.
Thank you.